Okay, folks, we are coming right up on the top of the hour. So we're going to start our presentation here. Hopefully everybody can see and hear. All right. I hope everybody can see and hear. Okay, great. Awesome. Okay, good. What you should be looking at right now is a chart of the U.S. dollar versus the Japanese yen, a daily chart of the U.S. dollar versus the Japanese yen, which is the charts that I use. It's a TradeStation chart as my charting platform here in the States. So hopefully everybody's doing well. If you guys want to start the recording, that'd be awesome. I'm not quite sure how to do that. So welcome everybody. Today is 2/19/14 Wednesday. It is 1600 Greenwich Mean Time, 10 o'clock here Central Time in the States where I live. I live in Chicago, Illinois. My name is Steve Misic. I am an instructor for the Online Trading Academy. I am somebody that's been with the Online Trading Academy now since around 2008. I am somebody that was an attendee of a workshop, what we call a power trading workshop, back in 2008 in Chicago when the Chicago franchise opened up, and I happened to attend that session, the very first session that they had. And after the session, I left and I called my very good friend and mentor, Sam Seiden, who all of you know very well as one of the premier instructors from the Online Trading Academy, and I told Sam that they had opened the franchise in Chicago, and he contacted Online Trading Academy and became the instructor for the Online Trading Academy in 2006. And in around 2008 or so, he became the lead instructor for the extended learning program. And the extended learning program was the electronic classroom. And he was teaching students in the electronic classroom how to trade using demand and supply. So I was one of his mentoring students. He asked if I'd come on board, and here I am today, talking to you folks today. So last time we were together, we started a series here on the dollar versus the Japanese yen. And what we did was we covered the movement in the dollar versus the Japanese yen, beginning all the way back here, and my charts are a little clogged up with lines, as you probably can see, but this is the type of analysis that we do at Online Trading Academy. And what we were actually going to do is we were going to pick up where we left off on the last session. I was going to actually cover the end of September and then begin with the beginning of October of 2012. And that is exactly where this market bottomed. Of course, this is a daily chart, so it's not quite as clear as my weekly charts. So let me bring up the presentation here. You should now be seeing a chart on a document that I created. It's a Google document. Google document is a wonderful document that I can use to create documents to document my trades and to keep track of trading concepts. Very easy to use. They give it to you for free here in the States. I'm sure they do elsewhere too. If you want, you can go to Google document and you can create your own online presentations. And what I really like about these presentations is the ease of use, the ability to share, and of course, a lot simpler than to try to email myself back and forth the latest versions of PowerPoint from Microsoft. So this document was created just using a regular document, and what I do is I insert on the document pictures of the charts that I take from that TradeStation platform that you just saw. So back in 2012, in September, the market for the dollar versus the Japanese yen began to bottom in what became the bottom of a long bear market. The dollar versus the Japanese yen is in a secular bear market, as I mentioned before, for approximately going on 40 years now, ever since they topped out in the 1970s at around 360 of a yen to one of our dollars, one of our U.S. dollars, and then bottom somewhere in the vicinity of 75 yen to one U.S. dollar. This market's been in a secular bear market for years and years. But periodically during that secular bear market, you're going to have what we call cyclical bull market rallies. And some of those rallies can be pretty good. The current rally being around 39% from the trough to the peak, from around 75 to about 105 or so. So at this point, we see the market beginning bottom in the last week of September, and in the first week of January of 2012, the market begins to rally out of this demand level. We call it a demand level because at the price level between 77.82 and 77.11, we had a pretty significantly strong rally in September, and price came back to the origin of that rally. And once it came into the level, which we call a demand zone with the two lines that you see on the chart, price bottomed in that level and began to reverse and rally out of the level. We teach our students that whenever you can locate an area where there's an imbalance of buyers to sellers in the past, as represented by this big rally that you see right here, then we want to pay attention to this area as a potential origin of an area where institutions may have some leftover unfilled buy orders. So that is the buy point right there. The stop loss would go right below this area here. And with the dollar versus the yen, I usually use a very small stop of a couple of pips below what we call our distal line of our supply zone or our demand zone. So now the market begins to rally out of there, and my thoughts, which I document on our little website here, which is the Online Trading Academy website. Let me get rid of that really quick. In the week of 10/2, when the market bottomed, and these are the actual post from the website on my blog where I keep track of these markets. By the way, I also keep track of the U.S. large cap stock market as represented by the SPY, the S&P 500 exchange traded fund, which had topped out around the time that the dollar versus the yen bottomed. And I keep track of the Indian markets for students in India. I was there quite a bit in 2012, and this is their Nifty. I also keep track of the U.S. bond market. And I also keep track of our wheat market, our commodity market, which was just beginning to top out at the time. This represents a sideways movement for a long period of time, which eventually resolved into a bear market in December of 2012. I was keeping track of a stock called Akamai Technologies for a while. I switched over to Apple Computer this year, at the end of last year. And here we have that chart of the dollar versus the Japanese yen. And my thought process at the time, as I posted on the blog, was Japan had joined the currency race to the bottom last week with another round of stimulus, aka money printing. And the dollar had sold off as a result. And that was the beginning of that rally. So the area right above us, near 78.70 at that time, was supply. But I wasn't really too worried about it because prices had managed to rally closer to 79.29 before actually falling. So at that point in time, that would have been a target for you if you were long. And depending on the size of the position that you took, that could have been one of several targets that you could have used as the market began to rally higher. I also keep track of the Russell 2000 small cap stocks on this blog. So these are the 7 assets that I keep track of every week for our students. Anyone that has access to this area of the Online Trading Academy website that's trading assets for short-term income and long-term wealth is advised, or it's advised, especially if you're new, to follow along with this kind of analysis, because our core strategy is basically the movement of markets between levels of demand, supply. And, of course, the movement usually resolves itself into some kind of trend. So at this point, the following week, going back to where we were at the time, we had the markets begin to fall away from that little area of supply, the dollar versus the yen. We actually fell down to a low of 78.17, and we were trading inside that range between 77.82 and 78.32. We did have some fear in the headlines at that time. And what happens is whenever there's fear in the market, we will have a tug of war between money going into the U.S. dollar for safe haven purposes and also into the Japanese yen for safe haven purposes. Of course, that money that goes into the Japanese yen is represented by short. So anybody that short the Japanese yen, and quite a few traders like to short the yen as part of their carry trades. Whenever they have fear, they're going to find themselves having cover by buying back their short yen positions, which of course will cause the yen to rally and the dollar versus the yen to fall. It did when it reached that supply level at 78.67. So we moved from there, and we moved the following week back up to this area on 10.17. So now we're starting to make lows with higher lows, which many of you will recognize as a potential reversal pattern. The actual reversal pattern that most people will notice is a shoulder on our side over here, and this is what we call the inverted head and shoulders. So we have a shoulder here, followed by a head here, followed by what's turning out to be a long shoulder here. And, of course, if I connect these higher lows, it's a sign of institutional accumulation due to the fact that institutions are now having to pay higher and higher prices in order to accumulate this pair. They generally will do that if they anticipate higher prices going forward. So maybe they would like to buy at 77.82, but if the opportunity doesn't present itself, they have to pay 78, and then they have to pay higher and higher prices, to where close to the end of this breakout period, they were paying 78.70, which means that they anticipate the prices to go higher. Of course, if you're a trader, we only look for clues of what we think is happening in the market. We do our best to decipher the clues as our price charts indicate. But one of the patterns that we always talk about in our classes is this higher lows and potential higher highs, which indicates the potential for a market to begin trending again. So as we go to the following week now, we're in the week of, let's see if that's 10:24. Oops, jumped a little bit too far ahead. And I seem to have some stickiness in this presentation here today. All right, so now on the week of 10/24, the market really begins to move higher. There we go. The week of 10/24 is when the new beginning of the bull market officially began. And the reason that we say that is because we've taken out the level of supply at 78.68. We've actually taken out the level of supply at 79.27. And now we're working our way higher. And as we do that, we're making higher lows and higher highs. And, of course, the definition of a trend is higher lows and higher highs. An uptrending market, definition of a downtrend is lower highs and lower lows. And as the market begins to rally and new levels of demand form below current price, these areas are potential buying opportunities for somebody that is what we call a pullback trader. There's two styles of trading. Obviously, the style of trading that most traders like is to buy momentum, to buy prices as they're rising, to go long as prices are breaking through areas of resistance or supply. And that style of trading, if that fits your personality, then by all means, you're encouraged to do that. The only thing that we say as far as risk management goes is Momentum traders need to have protective stop losses just in case the momentum of that breakout fails and the market begins to retrace the move. And we teach our students, of course, to look for buying opportunities on what we call pullbacks to demand levels as they form below current prices. The market's rallying. And that's kind of what's happening at this point. We have a market that's beginning to rally higher. So we're anticipating to join that trend. We're going to look to buy pullbacks to demand as a way to join the trend. Pull the plug on the phone here. Sorry about that. All right, so going back out to the blog, we see that on that week, and I'll just go back here really quick to the week of 10/24. We had quite a bit of bad news with the downgrades by S&P of the Spanish banks at the time. And one nice thing about this blog is that it's sort of like a history lesson for students. At that point in time, the S&P had rallied up into some major supply at the 147 area and was actually pulling back to a demand level at 142, looking like it was going to trend lower. And in 2012 was the last time we had a significant correction in our U.S. markets. So it's nice that I can kind of keep track of what's happening in the world at that time. So let's really quick go back over here. We can see that our dollar versus the yen was trending higher. And I mentioned that the dollar had a huge rally against the yen in the last week, pushing past our supply levels between 78.68 and 79.27. The next area of supply was 80.25, which is where sellers might step in. New demand near 79.30 should find buyers on the dips. The Bank of Japan is said to be under heavy political pressure to increase its asset purchase program to boost economic growth and fight deflation. And they may announce a new program at their meeting on October 30th. U.S. economic data later that week could push the dollar lower if stronger than expected. Either way, we just trade the levels. So my point always is going to be that there is a lot of great news that comes out. And as a matter of fact, this week, the Bank of Japan announced a doubling of their asset purchase program, which I find to be quite amazing. And, of course, we've had a little bounce in the dollar versus the Japanese yen as a result. So that's what we were looking at as a potential reason for why the markets broke out. I see some of you say that banks are calling me to ask where I would enter. Well, they were probably already in at this point. They were probably already participating in the move higher. I know a certain gentleman by the name of George Soros that made over $1 billion on the move that you're seeing here on the chart. So George Soros figured it out. He jumped in. I guess he gets the clue that when somebody talks about printing money, it's going to weaken their currency. And that's pretty much what happened at that point. All right, so now we're moving higher, and we did reach the 80.24 supply level. And when we reached the 80.24 supply level, we had a pretty significant pullback right down to the 79.31 demand level. At that point in time, if you were not in this trade, if you were not a participant on the breakout of the supply levels as a momentum trader, here was your first chance to enter at 79.31 with fairly low risk. We would encourage you to put a stop loss below 79.12 if you did buy. And, of course, if you were long, you should have taken a profit at that 80.24 area and moved up your stop loss from the initial stop loss to below 79.12, just in case we had a reversal of trend at the time. And that could have been a place where the trend reversed. So now we're on the last couple of weeks of October of 2012. And we're starting to look here on this chart of all the supply levels that still need to be absorbed on the daily chart here. going back, and we had supply all the way up to the 84 area at that point in time, and so the markets were beginning to work their way through the first area of supply and working its way up to the next areas of supply that needed to be absorbed before the market could go higher. So on 11/7, now we see where we have another pullback to a new area of demand. And notice, once again, we had a pullback to the 79.31 area of demand in October. Another area of demand formed above that one near 79.77. And so anyone, once again, looking for a buying opportunity, an opportunity to buy what we call a pullback or a retracement with fairly low risk, a little bit bigger risk than the people that were in from the lower level. They had their chance to buy that pullback in November of 2012. So the pullback to that level would have only netted you a slight bounce. As you can see, levels are forming now on top of other levels, and another zone pushed up. On the previous chart, we had a level from 79.77 down to 79.31, and price managed to actually push through that zone down to the lower zone, the one that had bottomed at previous in October, and once again began to rally, heading back towards that area near 80.24. So now it looks like we've pushed through on the week of 11/21. We've pushed through the supply level between 80.26 and 80.62. We've pushed through the supply level between 81.14 and 81.72, and we're now making our way to a level of supply between 82 and 83, which is a huge daily level. So as we continue to trend higher, and as we now look at the weekly chart, we have a bull market for the dollar versus the Japanese yen at this point. We now have a weekly demand level between 80.42 and 79.17. We've taken out smaller areas of supply up to the 82 level. We call this weekly trend the primary trend, and we had just switched from a downtrend to an uptrend at that time, and I hadn't updated the chart, but the intermediate term trend and the shorter trend were also up. The primary trend for me is the weekly chart. The monthly chart, of course, is the secular trend, and that's obviously bearish at this point. So now on 11/28, the market has rallied into the 82 supply level, and we've fallen from that level pretty good. We're starting to drop back towards a new demand level that's formed between 81.42 and 80.96. Now, these are daily supply levels and demand levels. And obviously, the market can and does push through these levels quite easily, especially if the sellers are very aggressive. But at that time, we were in the supply level at 82.36 from the weekly chart. We had been in there for now going on 3 weeks. And what we're trying to do at this point is we're trying to go sideways. There's obviously buyers and sellers. But at this point, where buyers and sellers were mostly in equilibrium, for every buyer there was a seller, we had a pretty strong rally into the level, followed by a indecision candle and a slightly red candle in the first week of December of 2012. And this is actually a weekly chart, so let me just update that. Okay. Very good. All right, so this is a weekly chart. Now, whichever one of these levels, the big level of supply between 82.36 and another level above that at 84, whichever one of these goes away is going to be the next trend. And obviously, we have started a new uptrend, so those nearby levels of supply are probably going to go away. So we're still inside this weekly level a week later on the 12th of December. But now we're beginning to trend higher once again, and we're creating another level of demand as we do it. And this level of demand is between 82.47 and 81.68 on the weekly chart. And the following week, we have a gap into the supply level between 84.13 and 85.42, a weekly supply level, which has been tested once. And that last test on that level had happened back in the early part of 2012, around April, March or April of that year. So this is our second time into this level. And what we teach students, which is quite a bit different from the technical support and resistance, is the more times prices visit a level of demand or supply, more of the buy orders and sell orders get absorbed. In this case, the sell orders are being absorbed as price visits the level. So the old textbook is support becomes stronger the more times it's visited, resistance becomes stronger. But according to Sam, who actually had the orders on his desk, he said every time price visited that stack of orders, the stack of orders got smaller. So when the last order was used up, in this case, last sell order, we were going to rally through. So his explanation of how supply and demand worked seems to make a little bit more sense. I always found that to be the case, that every time we come back to a level, we use up more and more of the supply in the level in this case. And eventually we take out all the supply and we rally through. Now, anybody who was swing trading this for longer term position trading or swing trading would be advised to put their stop loss on the balance of their position below the demand zone at 81.68. So now we have two levels of weekly demand forming below current price, and we're working our way through this 84 level of supply. So here we are in the last couple of weeks of 2012. We've managed to push all the way to 85.38. So this uptrend is pretty solid looking, and now we have several demand levels on the daily chart below current price. Pockets of demand between 84.38 and 83.61, all the way down to 82.50. And some of these levels were not visited on the way up. As we entered January of 2013, we're now currently trading at 86.74. We've now managed to rally 12.41% off the lows of the previous year. And so this rally is beginning to gain some traction. And as a result, a new demand level on the daily chart has formed between 86.08 and 85.59. The 2nd of January finds the markets now trying to test the area of supply on the daily chart between 87.43 and 8800. And we've actually had the holiday. The banks have squared off for the year, which they typically do at the end of a year. And as a result, we have spaces in between our candles to represent the New Year's holiday and, of course, the Christmas holiday here in the States. So these levels that have formed during these last couple of weeks of December, they look pretty good, but they may not contain quite a few orders, as many orders as if the banks were all working during those weeks. So I always tell students to be careful of buying those pullbacks to those levels, just in case there's not a lot of orders. At this point, on 1/9/13, the market has rolled over temporarily at least, and created a pattern of supply. And as soon as it created that pattern of supply, a day or so later, on 1/9, we actually tested the supply level. So if we were to push through the supply level, obviously the trend continues higher, but if there are sellers in the area, then we could have potential to go down to the 86 area. So it looks like we actually did have a sell-off the following week. And we were pushing on down towards the 87.82 area, which means that we had a little bit more of a rally between the week of 1/9 and 1/16. We managed to rally as high as 89.50. So we did have a little pullback and almost immediately a rally after that. So instead of a supply level, what we actually did was create a demand level between 87.82 and 86.87. So the pattern is a little bit of basing with a rally that went to the highs of 89.50 or 89.63. So we'll see if the market wants to pull back to this level to join the potential uptrend. On 123, we are now over 90. So we did have a small pullback on this date right here, and that date would have been, I believe that the 16th candle, we actually did touch the demand level at around 87.82. Looks like the low for the day, according to my chart, was 87.78. So we tested the level by about 4 pips. And at that point, we bounced off the zone, and we actually had a solid rally the next day, which took us to the highs. And those highs were actually all the way up to 90.27. So now we're up 15.63% from the lows of the prior year, rallying from the 75 area to the 90 area. And we've created a demand level that's already been tested at 87.85. And so now it looks like we're going to come back down here and test this level again for the second time. And in the process, we've also created a daily supply level between 89.61 and 90.27. So from my understanding of what Sam explained to me years and years ago, markets go sideways until supply levels are absorbed. And then, of course, we trend higher, or demand levels are absorbed and we'll trend lower. So at this point in time, the only thing we suggest our students do is, if you are long and you want to protect your gains from lower levels, you'd probably want to have your stop loss somewhere below 86.87. And if you're interested in two-way trading, you could definitely, if the reward risk fits your profile, you could definitely trade long near this demand level of 87.85 with the supply level as an area that reverts to a short. And of course, this level could last for a while. Or the markets could turn right around, go through the zone and move higher, as we know they did. And at this point in time, on the last week of January of 2013, we did not, it looks like we did not quite test the demand level. And we didn't stop at the supply level either. We pushed through that level, and we actually moved all the way up to another zone at around 91.36. So no one who went long got stopped out on the lower levels if you had your stop below 86.87. But if you did take a short trade, unless there was some selling on that intraday candle that came up to the level, you probably got stopped out. This is one thing about the trend having switched to uptrends at this point in time. Shorting is certainly something that you can do for short-term income. But if the trend has switched to bullish, as it has at this point in time, you are trading against the trend and you do get stopped out quite a bit. So I've gone back now on my chart, and I've looked for the next area of major supply on the charts, and I had to go all the way back to sometime in 2010, around the middle of May of 2010. And I located an area of supply near 94.50. And so I've taken a picture of that. And on the blog, I'll, of course, point these areas out to students as potential targets for anybody that is long and for anybody that's maybe looking for some counter trend trades on an area where there was a sharp sell-off in the past. This would be the next area above current price, because the market at that point in 2013 was making new highs for the year. So now we have to go back to the left, and we have to find an area where prices fell in the past, and this is it. This is one of those areas from May of 2010. So price reaches this area, and it's now up 22% from those lows. It's trading on this chart here at 93.79 the day I took this picture on 2/6 of 13 on the weekly chart. And if you look at this picture, and of course, when I teach a class at Online Trading Academy, in every asset that I teach, I show students this picture because this is what a sideways accumulation phase followed by a bull market phase looks like. This is the way I look at markets. This is the way I've looked at markets ever since I discovered the trending philosophy that I use, and that is the sideways accumulation followed by a markup phase or bull market phase, followed by a distribution phase, and usually a bear market phase. But in this case, this market is now clearly, most people would agree, pretty solid in an uptrend with a 22% rally from the prior year lows. Okay, so now we're in the week after that, and we did find some selling at that 94.47 area on the daily chart, and we had created a demand level between 92.73 and 9200, and another one below that at 9100 to 90.15. So now you'll see that in the next few weeks, what generally will happen is the price will go sideways between these levels. And it's kind of what it's doing here. It's testing the 92 area, bouncing up and testing the 94 area. And chartists will begin to notice lower highs and higher lows, which is a chart pattern known as a symmetrical triangle. Whichever way it breaks out, most chartists would go with that breakout, either to the upside or to the downside. What they don't know is if they don't book their gains pretty quick, you may break out to the downside, but you'll definitely find some buyers in the 91 area. And if you do break out to the upside, you still got the sellers up at the 94, 94 and a half area. So we're not really big on chart pattern breakouts. We're more of trade level to level. And we did, after going sideways for quite a period of time, looks like the entire month of February last year, we went sideways between the 94.50 and the 92.70 area before breaking down to the 91 area. And now that we're bouncing off that area at 91, once again, if we take out the demand level between 91 and 90.15, we will go lower, and our next level of demand below current price, where the next stack of institutional buy orders is between 88.60 and 87.82. And of course, we still have the supply level up ahead, should we decide to rally higher. As it turned out, the market did rally from the 91 area, rallied once again, rallied again at the 92.50 area, working its way once again towards the 94 area. I put a question mark around this area between 92.55 and 9200. Demand with a question mark, because it might be demand under normal selling. It is the origin of a rally that went to the high of the previous few days. But if there is aggressive selling, it wouldn't last very long. And one of the reasons students have issues trading levels is because you're definitely what we call on the wrong end of the curve to be looking for aggressive longs. Buying the pullback to 9100 would be okay, and if your stop was below 9200, you've at least locked in a profit. But aggressive sellers can and do sometimes push prices quite a bit lower. So now it's March 13th of 2013. And as I'm looking at this chart, I noticed that there was a week here where we pushed all the way down to 91. And that weekly candle closed actually as almost a bullish hammer reversal candle, followed by a big rally into the 96 area. Okay. So this area of 96 is now our new supply level that we're pushing through, and the rally's reached 25%. So I have a question here from Boyke about what do we mean by the curve. Well, what we mean is certain areas of the chart down in this area here, from where the origin of the rally actually started, are better areas to be buying versus where we currently are at this point. And the reason is because the higher prices go, the more likely you're going to run into aggressive selling for profit-taking purposes for anybody that is long. And we're pushing into areas, once again, where large institutions may have orders to sell. And obviously a move from 77 to 97, almost 20 cents. It's coming on almost a 20-cent move. There are interested sellers the higher you go. So we always tell students be careful buying when prices had a big move higher like it has here. Okay. All right. At this point, we formed another little tiny demand level the week of 320. And this one's between 93.50 and 92.50. So it's not little. It's 100 pips. But it is above the one that was below. So now you have, again, protection from your long trade from the pullback in this 91 area. And we've, again, rolled over at 95, and that's potential supply. And now we're going to see which happens next, which one of these levels goes away first. So we come down to the 93.50 level from the 96 level. So we actually rallied up to 96.04, created a level. We rallied into that level at 96.04. I believe that was a little bit higher. So sometimes I will readjust my lines, especially when I open up my charts. It looks like my supply level should have been closer to 96.04 instead of 95.93. And I did readjust those lines a little bit. And when I did, I created that zone between 96.04 and 96.70. We rallied back up to the level, then we pushed down to the 93.50 level, and we were working our way back towards the 96 area once again. And here we are now on April 3rd. And we have pushed through this 93.50 level, and we've bounced off the next zone at the bottom, 92.50. So the sellers are becoming a little bit more aggressive up here. And as that happens, levels of demand get pushed through. And this one at 93.55 was pushed through. We were at the back end of the zone where we had a little tiny bounce from 92.55 up to 93.65. And then on April 6th, we had a pretty sharp rally all the way back up to the 97 area. And that pushed us through the 96 zone into the 97 supply zone, which went up all the way to 98.80. So that was a huge level up there. And notice, again, we've created another area at the origin of this rally of demand between 93.43 and 92.50. So on 4/10 of 13 on the daily chart, the rally extends into the 99.79 supply zone where option defense barriers halt the rally. Well, as somebody who's been in the currency markets for years, and I know about option barriers, and I'm pretty sure you've had speakers on this website before talk about them. Option defense barriers are something that's unseen supply, and generally a very popular technique for banks to trade when they want to trade currencies without actually trading the spot currencies is to use other derivatives such as exotic options. So as we wrap up our second webinar in this series, I see we're coming up on 45 minutes here, and we've got until April of 2013. We will have another part 3. And we'll try to push ourselves farther along in this process. Hopefully, though, by me doing this, and I do it for my students at Online Trading Academy too, primarily to show them that it's just really markets moving from large areas of orders to sell to large areas of orders to buy. And of course, there are trends. A trend like the Bank of Japan or some other central bank printing money at the rate of 5 times the rate of the United States is probably going to weaken that currency eventually. And I'm sure there's a lot of currency experts that come on these webinars calling for much, much higher prices of the dollar versus the yen. With us, we trade level to level. And so next time I get another webinar here on the website, I'll do the same thing again. Okay? And hopefully that's helpful to you. But for today, that's going to be a wrap. Okay? If you get a chance, watch the recordings of part 1 and part 2 for more explanation on the methodology. And sometime in March, when I get free time, I will come back and do part 3. All right? And thank you to all of you that have attended. And thanks for inviting me again, FX Street. And have yourself a fabulous day, and we'll see you next time. Take care. Bye.